David, thanks so much for joining me. What did you think? Is Tesla kind of a harbinger of things to come?
Let's hope so. And, it was a rough day for me yesterday because I did not own Tesla, and that was pretty costly. Being up 20% in a day, it's 1.2% of the index. So if you missed out on that, that cost you 0.25% yesterday in relative performance. So I didn't like the fact that I didn't have it. I'm going to have to find an entry point. I don't know if it'll be today, but maybe some point real soon.
Okay, so you liked that. I mean, certainly the Mag 7 recently has been kind of the lag 7 as investors get an appetite for everything else. And last earnings season, if memory serves, I mean, these stocks got really punished on really slight sort of misses. What do you think the flavor is going to be like this time around?
I think you have to separate them out. They're not all the same. Some of them actually have some secular challenges. Certainly Alphabet, it's still very cheap. I own the stock, but I own a smaller position than I did, in large part because their dominance in search, their monopoly in search, that's been broken. Very clear that there are going to be other players in this space. I guess my favorite in the group is Meta. They seem to be one of the early adopters of AI where they're actually making money on it. They're not just pouring money out to build out the infrastructure. It's actually increasing their earnings and cash flow. So I think you got to separate that out and do your homework there. I
would also like to bring up Apple here because there was a downgrade. Apple cut to sell today by an analyst at KeyBank, which is rare for Apple. There's only 3 sales. Really just saying the growth expectations for Apple are too aggressive. It's expected to be the best in 3 years. And I guess we should put best in kind of parentheses because it's still like really tepid growth. But for Apple, that's better than declines.
We give Apple a pass on a lot of things, just simply because it is Apple and it is such a dominant force, and they can kind of chart their own path. I think what they did with the way they're going to roll out their AI platform, what they call Apple Intelligence, it's going to come later than expected. You're not going to see anything right now. I actually went to the Apple store to buy the phone, and when I looked at it, and they say, well, what's working, what's not, and there were so many things not working that I said, you know what? I'm going to wait a little bit and see how this pans out. I suspect that probably the big phone is not going to be the 16. It's probably going to be the 17 or beyond.
Okay, so you're kind of sticking with the meta trade. What are you doing with Nvidia?
Nvidia, I still own. It may be my largest position right now. I haven't seen any change right as of yet, and. I think we underestimate how dominant the AI trade is going to be. It's going to move beyond the technology area of the market. It's already moving throughout the industrial complex, and it's already making us all more productive. I think that's what we miss on the market, because the productivity bump that we're going to get over the next couple of years is probably going to be pretty large. Right now, we're expecting 1%, maybe 2%. What if it's higher than that? If it's higher than that, you're going to get multiple expansion. You're going to be looking at a higher market.
Well, I want to talk about that because I'm just looking at your price target for the S&P 500, calling for S&P 500 6,850. How do you get there?
The math is pretty simple. I think the productivity bump is going to cause multiple expansion. I think we could get to 25 times blended PE. That's where you're looking 6 months forward, 6 months backwards. You take that 25 times next year's number, which is right now sitting around 274. You get to 6,850, about 1,000 points from where we are right now. The caveat to that, we're so dependent on interest rates, and that's what's been holding back the market. If the 10-year continues to rise, we're going to be having a very different conversation about Apple, Nvidia, and a lot of stocks. If we get above 5%, then my target's way off. You could cut 2,000 points off that target.
I mean, that's good perspective, but just to put into context, we're already looking at an S&P that's up 22% so far this year. Your target implies another 18% move from here. Just in terms of life and timeline of bull markets, and the fact that rates are sort of a question mark in terms of does the U.S. economy slow down at some point? Go ahead.
I'll have to adjust that. If rates continue to climb. I'm not expecting that as of yet. I think markets can certainly handle 4.5, 4.6. Above that, then like I said, it is a different conversation, and it really behooves us to get our Fiscal Act together, because that's in part and parcel what's really happening here. Growth solves a lot of problems. Even with deficits, growth can solve a lot of problems. So we'll have to see on that. But right now, based on if rates stay where they are right now and they stay relatively benign, I think my target is very achievable.
But rates are rising, even though the Fed cut interest rates. You know, the long end, the 10-year is moving higher. Is that not a signal from the bond market that these rate cuts are going to be stimulative, that there's going to be growth there?
There will be growth. I'm not sure we're going to get above 4.6, 4.7. This is probably maybe a good area to extend duration if you miss the bond rally at this point. But, you know, markets are a living, breathing animal, Amber, and we adjust as we go along. I can't be certain that if rates get above 5, then my playbook is wrong. I'm going to have to go back to my 2022 playbook. And we're going to be shifting from large cap secular growth to value, but we're not there yet. And as long as that doesn't take place, then I'm going to stay invested in the names that I have right now.
Can I ask you about this stunning blow that was dealt to Capri, which owns Michael Kors, which was supposed to be taken over by Coach, whether on those issues or just the FTC really going against a lot of these transactions that they view as anti-competitive. You know, I'm seeing shares of Anderson's, which is supposed to be taken over by Kruger, but the FTC's got an issue with that as well. I mean, how are you thinking about the FTC, M&A? You know, does it affect how you decide to play some of these M&A plays?
Well, it's not a space that I play in because it is as difficult as you say. But we have an election coming up, and you could be looking at a very different backdrop, 6-7 months from now. I'll have to judge it after that. But M&A is a big part. It's a real drag on venture capital because they need an exit. And frankly, if you're too aggressive on the M&A front and you shut it down completely, as this administration has, it makes it very difficult for venture capital to move on to the next platform because there's no buyout. There's nobody to take that company out. So I don't want pure monopolies, and some companies have become too large. I get that, but you can take it too far. I think the administration has done exactly that. So
does that mean if under Trump, if Trump is the president, that you think we could see a lot more deal activity?
I think you're going to see a lot more deal activity under President Trump, but the election's less than 2 weeks away, and it's going to be very interesting. That's probably one of the biggest risks on the market right now, at least in the short run, because you could have lawyers with parachutes, targeting into every county in the United States where there's a discrepancy on a vote. This is an election that could ultimately be decided by the Supreme Court. Markets aren't going to like that. It'll be very disruptive, something like 2000 Bush Gore.
That's good perspective of the volatility that could happen after. I just want to ask before I let you go, how much stock you put on the Trump trade that seems to be put on? Markets are voting that it's going to be a Trump presidency. I don't know how predictive that is. Maybe you've got some insights into that?
Well, in markets are probably maybe more accurate than polls in that you're playing with real money, all right? It's a lot different when somebody calls you up on the phone, you can say anything you want. But when your money is at risk, that's a vote that has some substance to it. So, yeah, I'd probably give the markets maybe a better indicator of what's going to take place in, about 12 days now.
All right, we will see. David Nelson, thanks so much for joining me. That's at Belpointe Asset Management. We're going to take a quick break.